If you had to start investing from $0 in 2026, what would you actually do? No portfolio, no trust fund, no crypto moonshots, just you, a paycheck, and a blank financial slate. Headlines are loud. AI is reshaping industries. Interest rates aren't near zero anymore. Housing still feels expensive. Most people look at that landscape and freeze. They assume they're late. They assume the game is rigged. They assume you need money to make money. But here's the truth most people miss. Starting from $0 in 2026 is not a disadvantage. It's clarity. Because when you have nothing to protect, you can build correctly from the ground up. Today, I am walking you through the complete strategy I would use if I had to start over from zero. No fluff, no hype, no get-rich-by-Friday nonsense, just math, psychology, and a repeatable system. And if you treat this channel like your weekly financial strategy session, consider subscribing, because my goal is simple: give you the highest return possible on your time here. Now let's build this the right way. Before we talk about investing, we need to talk about something uncomfortable, because if you're starting from $0, there's a high chance you're not actually at zero, you're negative. Credit cards, buy now, pay later balances, car loans at double-digit interest. And here is the brutal math. If you were paying 22% interest on a credit card, that is a guaranteed negative 22% return. You cannot outinvest that. I don't care what ETF TikTok is pushing. Trying to invest while carrying high interest debt is like trying to fill a bathtub with the drain open. And here's what makes this dangerous. It doesn't feel urgent. It's just a monthly payment. It blends into your life like a Netflix subscription. But psychologically, debt changes how you think. You hesitate to switch jobs. You avoid negotiating salary. You stay quiet when you should take risks. Debt shrinks your courage, and wealth requires courage. So if I'm starting from $0 in 2026, phase one is simple. I become a debt eliminator, not an investor, not a trader, a destroyer of negative compounding. The protocol: list every debt, sort by highest interest rate, attack the highest rate first, minimum payments on the rest. Every extra dollar goes to that highest rate. Sell unused items. Pause subscriptions. Channel your inner minimalist. Treat it like an emergency. Because mathematically, it is. Once the high interest debt is gone, we pivot. But here's where most beginners make their second mistake. They jump straight into stocks. Let me ask you something. If your car breaks down next month, how are you paying for it? If the answer is credit card, you're not ready to invest. I know that sounds harsh. But investing without a cash buffer is like building a skyscraper on sand. Markets correct, jobs disappear, life happens. Historically, the stock market drops 10% almost every year and 20% every few years. If you're forced to sell investments during a downturn to pay rent, you lock in losses. And that destroys compounding. So phase two is building what I call a cash fortress. Not because cash makes you rich, but because it keeps you from going broke. The target: 3 to 6 months of bare bones expenses, rent, food, utilities, insurance, nothing fancy. Put it in a high yield savings account or a money market fund. In 2026, yields are still meaningfully higher than they were during the zero rate era. That's a gift. Now here's the psychological unlock. When you have cash reserves, you negotiate differently. You think long term. You don't panic sell. You sleep better. And sleep is an underrated investing strategy. Once that buffer is built, now, and only now, you become an investor. And this is where most people overcomplicate everything. You might think investing from $0 requires genius stock picks. It doesn't. It requires discipline. In 2026, AI stock pickers will be everywhere. Apps promising algorithmic alpha. Next NVIDIA alerts. But here's what decades of data show. Over long periods, the majority of professional fund managers fail to beat the index. Professionals, so don't try to beat them, join them. Or rather, join the market itself. Forget picking stocks. Buy the whole market. For someone starting from scratch, I'd focus on 1 or 2 broad, low-cost index funds. Something that tracks the S&P 500, or a total world stock market fund. The goal is not to find a needle in the haystack. The goal is to buy the entire haystack. Your strategy becomes simple. Automate your investments every single payday. That's it. You're not trading, you're not timing the market, you're just consistently buying a piece of the global economy, month after month, year after year. This boring approach is what builds real wealth. It's not glamorous, it won't get you a million views, but it works. Destroy debt, build a cash fortress, and then automate buying the index. That's the blueprint. Thanks for watching, and I'll see you in the next one. With research teams, Bloomberg terminals, you and we need a smarter strategy. Instead of picking the needle, buy the entire haystack. Broad market index funds, total US market, S&P 500, some international exposure. Historically, US equities have returned around 8 to 10% annually before inflation over long periods. Is it guaranteed every year? No. Is it reliable over decades? Historically, yes. And wealth building is a decades game. Now here's something most beginners don't hear. When your portfolio is small, focus beats over diversification. You don't need 17 ETFs. You need consistency. A simple core approach, 80-90% in broad index funds. 10% max for curiosity investing, individual stocks, higher risk plays. That 10% scratches the itch. If it doubles, great. If it crashes, your life is fine. Good investing should feel boring. If it feels exciting, you're probably gambling. The tax shield, where you place the money, matters. Here is a mistake that quietly costs people hundreds of thousands of dollars. They invest in the wrong accounts. Returns matter, but after-tax returns matter more. If your employer offers a 401k match and you're not taking it, you're declining free money. That's an instant 100% return. Then comes a Roth IRA, tax-free growth. Imagine investing $8,000 a year for decades and withdrawing it tax-free in retirement. That tax shield alone can mean 6 figures difference over a lifetime. Here's the order I'd follow in 2026. 1. 401k, up to employer match. 2. Max out Roth IRA if eligible. 3. Consider HSA if you qualify, triple tax advantage. 4. Then return to 401k. 5. Only after that, taxable brokerage. This isn't flashy, but this is how you quietly outrun most people. The accelerator. Now here is the truth that no spreadsheet can ignore. You can only cut expenses so much. There's a floor to frugality. But there is no ceiling to income. If you're making $40,000 a year, your greatest investment might not be the stock market. It might be yourself. In 2026, high leverage skills matter more than ever. Data literacy, AI integration, sales, negotiation, technical specialization, project leadership. A $15,000 raise compounds far more than skipping coffee. And that raise increases. 401k contributions, employer match, social security base, future raises. Your income is the engine. Invest 1 hour a day learning something valuable. 6 months from now, you're not the same person. 12 months from now, your earning power changes. That's how you accelerate from $0 to 100K. Here is the complete playbook. If I woke up in 2026 with zero, this is exactly what I'd do. 1. Eliminate high interest debt. 2. Build a 3 to 6 month emergency fund. 3. Capture employer 401k match. 4. Max Roth IRA. 5. Invest primarily in low-cost index funds. 6. Limit speculation to 10%. 7. Upgrade income relentlessly. No hype, no gambling, no shortcuts. Just compounding plus discipline. And here's the part most people won't like. The first year feels slow. The second year feels steady. The third year, momentum starts. And somewhere around year 5, you look up and realize you're no longer starting from zero. You're playing offense. Investing from $0 in 2026 isn't about timing the market. It's about building a system that works in any market. If this breakdown helped clarify your next step, hit subscribe. Because every week we're building real financial intelligence here, not internet hype. And I want to know, if you were starting from $0 today, which phase would be hardest for you? Drop it in the comments. I read them. Because wealth isn't built alone. It's built with awareness and execution. I'll see you in the next one.